Hi investors, welcome to SOIC. So in today's video, we learn one of the most important accounting ratios. And this accounting ratio can help you to save your hard-earned money. We will learn this accounting ratio from scratch and we will apply it across multiple sectors. And this ratio can actually help you a lot to derive insights into the business's bargaining position as well when it comes to its suppliers and customers. But before starting the video, I will also like to announce that there is a free book giveaway during the video. And to participate in that free book giveaway, make sure that you're subscribed to the channel. If you haven't subscribed to the channel, then you can subscribe and also make sure that you like this video. With this, let's start. So in the beginning, first I'd like to tell you what is the name of this ratio. Simply this ratio is known as CFO to EBITDA ratio. What is it known as? CFO to EBITDA ratio. That is cash flow from operations upon earnings before interest, taxes, depreciation and amortization. So what is cash flow from operations? So simply what cash flow from operation means is what the word itself says. That how much cash is the company generating out of its operating activities. That is the meaning of cash flow from operations. To calculate cash flow from operations, we typically start with profit before taxes, add all the non-cash expenses back. Like depreciation is a non-cash expense, so that is added back. So even interest expenses are added back because that belongs to cash flow from financing activities. So all non-cash expenses are added back and all non-operating income is subtracted from profit before taxes. Why non-operating income is subtracted? Because if a company is earning dividends from its investment, then that is not cash generated from operating activities. Just remember this. Then after this, we get to a statement that is gross cash flow, and from gross cash flow, we also subtract all the changes in working capital. What is working capital changes? Things like trade receivables increasing or decreasing, trade payables increasing or decreasing, and inventories decreasing or increasing. And post this, we subtract taxes, and then we finally get to cash flow from operating activities. So this is how we get to cash flow from operating activities. What is EBITDA? EBITDA simply means earnings before interest, taxes, depreciation and amortization. So what is the meaning of EBITDA? EBITDA is simply cash operating profits. That if you just look at the company's operating profits, which are the cash operating profits, if you exclude depreciation, interest expenses, taxes, just those profits which the company is generating out of its core business activities is termed as EBITDA. And looking at cash flow from operation to EBITDA will give you an idea that how much of the cash flows has the company been able to convert from EBITDA. Because EBITDA is on the basis of income statement, which works on the basis of accrual principles of accounting. What is accrual principles of accounting? That revenue is recognized when a sale is made, not when cash is received. This is something that you have to remember. If I make a sale of ₹1, then I will recognize those revenues. It doesn't mean that I have necessarily received that ₹1. This is why we get the concept of trade receivables, inventories and everything else. So this is why we have to remember that if a company is able to convert more than 60% of its EBITDA into cash flows from operation, specifically B2B businesses, that is businesses which are selling to other businesses, then this means that the company has very less money which is stuck in working capital. So this is what we are going to learn throughout the session. You will see that B2C companies, the companies which are selling to customers, will have very high CFO to EBITDA because there is no trade receivables. Suppose if you go to a burger shop and you want to have a burger, right? So you won't say, "Ki, I'll pay you after 3 months." You will pay then and there on the spot. So what will end up happening is that the company will have very less money stuck in trade receivables. Similarly, if you go to a hospital and if you get treated, then you have to pay then and there. And what will end up happening is that the CFO to EBITDA for the hospital sector will also be really good. But if you are a chemical company which actually holds inventory for your own customers, then what will end up happening is that your CFO to EBITDA ratio can be really, really poor if majority of your money is stuck in inventories. Now, some of you will ask, why not CFO to PAT and why CFO to EBITDA? Simple reason is because CFO to PAT can get distorted because of other income. Because other income means that part of income which is generated from non-core business activities. So when we calculate EBITDA, it is calculated X of other income. Whereas when we come to profit after taxes of a company, then other income also gets added, which distorts the calculation of CFO to PAT. This is why we preferably like CFO to EBITDA, and we like to compare CFO to EBITDA across sectors. So in the forthcoming section of the video, we'll be comparing CFO to EBITDA across industries and across different players within the industry. Just before going forward in the video, if you really want to learn how forensic analysis works and how fundamental analysis works, then that is a part in the SOIC membership. Because in fundamental analysis, it is not just about forensic analysis or CFO to EBITDA. You also need to understand the prospects of a business, that how the company is evolving, what are the tools we can use for researching a company, what are the various sources that we can use which can help you to cut short your journey in filtering a stock. And apart from that, we will also learn that how you can buy a stock, sell a stock, and how you can ride a stock at different points of time using an automated criteria which will help you to understand when to buy, when to sell, and how to ride. These three concepts will also be covered in the SOIC membership. Along with that, this basic doubt that students do not understand that how to filter a particular stock. So there is an entire course on filtration and screening of stocks which will also be a part of SOIC membership. And also, if you want to learn how to pick mutual funds, how to pick debt funds, how to invest and make your own financial planning from scratch, so that is also a course that is a part of SOIC membership. So in SOIC membership, there are 6 key levels, and all these 6 key levels will make you a smart and intelligent investor. If you really want to learn and improve yourself as an investor and compound for multiple years, then SOIC membership covers everything from fundamentals to technicals to when to buy, when to sell, until how long to ride. So see you inside the SOIC membership. तो अब हम जितनी भी इंडियन कंपनीज है in different sectors, what we will do is that we look at the CFO to EBITDA conversion ratio of them. And we will actually try to do a lot of case studies with you that which company is actually has a very poor CFO to EBITDA conversion ratio and which company has a very good CFO to EBITDA conversion ratio. So first what I'll do is I'll deep dive into the chemical sector to look at the average CFO to EBITDA conversion ratio. So remember in the first part of the video we talked about that CFO to EBITDA just tells you that how much of the operating profits have converted into the cash flow from operations of the company. Because income statement, remember, is made on the basis of accrual principles, whereas cash flow from operation will tell you that how much of the cash is flowing into the company. This is why it is known as cash flow from operations. So CFO to EBITDA becomes a really important ratio. So what is the rough thumb rule that we use? That in a B2B businesses, like maximum the least that you can go to maybe be 60 to 65%. But in some of the businesses where the inventories are higher, you'll also see that the CFO to EBITDA ratio will be 55% types. And in the B2B or B2C businesses where cash conversion is really good, where the trade receivable days are really low, you will see that the CFO to EBITDA ratio will be anyways above 65 to 70%. So let's look at the chemical sector and let's look at SRF first. So you'll find this sheet in the description box below. So let's look at SRF first. Now over here for SRF, we can see that the CFO to EBITDA ratio for last 5 years has been 77%. Whereas in last 3 years on an average, it has been 80%. Whereas if you look at the entire sector, so SRF CFO to EBITDA ratio, we can say is one of the better ones in the entire sector. If you look at Apcotex, even in Apcotex case, the CFO to EBITDA ratio has been 82% in last 3 years. Whereas in last 5 years, it has been close to 77%. What does this mean? It simply means that these companies are able to convert 77% of their EBITDA, that is earnings before interest, taxes, depreciation and amortization, into cash flow from operations. And remember that EBITDA is also known as cash operating profits. So they are able to convert most of their operating profits into cash flow from operation. Whereas if you look at Gujarat Fluorochemicals, for last 3 years, this stands at 97%. Again, this is one of the better ones. If you look at Deepak Nitrite, it is at 68%, right? Again, one of the better ones. If you look at Aarti Industries, it stands at 75%, right? Again, a better one. But if you look at Balaji Amines, this stands at 49%, which is on the lower side of things. If you look at alkyl amines, it stands at 73%, which is on the higher side of things. So again, some people always get confused that why is there a discount between Balaji amines and alkyl amines? Simple reason, because if you look at inventory as a percentage of sales or trade receivables as a percentage of sales, then Balaji amines has poorer working capital versus alkyl amines. So this is one of the reasons why the discount exists. If you look at Anupam Rasayan, then it is barely at 4% for the last 3 years average. So again, this is one of the lowest in the sector perhaps, and this is something that while you're analyzing the company, you should really get to the bottom of this, that why is the CFO to EBITDA for Anupam Rasayan the one of the lowest in the sector. Even for Neogen Chemicals, it is barely 24% in the last 3 years average. So basically only 24% of their cash operating profits they've been able to convert into cash flow from operations. So the company will have to keep taking debt, or the company will have to keep raising equity to invest in future capex. So this is with the chemical sector. Let's look at the pharmaceutical sector. So pharmaceutical sector, both Laurus and Divi's have more than 55% CFO to EBITDA conversion ratio, which actually for this sector is really okay, because in this sector your inventory usually is higher, right? You'll see that inventory is 36 to 38% of the sales. If you look at Gland Pharma, it is also 57%. But if you look at Solara is actually negative 55%. And if you look at 5-year average, it is 0%, right? So again, because the company would have taken a huge loss on their EBITDA level. So again, which will start reflecting. And if the company has actually if the company's cash flow from operation becomes negative, even then you will see the CFO to EBITDA will turn negative. Let's open Solara over here, right? So I'll just open Solara over here, and I'll just look at the cash flow from operations. You'll see that minus 242 crores, right? So this is a company we studied, but the moment cash flow from operation turned negative, that was the point of time I got really scared in this company, because cash flow from operation turning negative points to either the inventory has become really high as a percentage of sales, or the receivables have become really high, which happened over here. It went to almost 41% of the inventory went to almost 41% of the sales, and receivables went almost to 36% of the sales. Then if you look at the example of over here, I'll give you one unique example, that is of Wockhardt. If you look at Wockhardt, then you'll see that CFO to EBITDA is high, but look at CFO to PAT, right? So this is where CFO to PAT can help you, right? Because what ends up happening in such scenarios is, like in scenario like Wockhardt, so I've opened Tijori Finance here in front of you. So if you just come to basically if you in Tijori Finance, if you just come to the cash flow statement, you will just find something that is really interesting, is that in the case of Wockhardt, that the company has cash flow from operation of 225 crores, whereas capex is 59 crores, right? Interest payment is 216 crores, new debt issued is 568 crores. So free cash flow left for equity, right, to the equity shareholders is minus 618 crores. And this is not the story of 1 year, this is a story of last multiple years which has been happening in Wockhardt, right? That you will see the cumulative cash flow from operation for Wockhardt has been 2,885 crores, whereas cumulative free cash flow left for the equity shareholders is negative 4,362 crores. It means that the company is a treadmill business and they are not able to make any cash for the shareholders. Just look at Wockhardt, right? Just look at Wockhardt and you'll see that the margins are really volatile. And if you just look at the profits, like the income statement just indicates that they've been loss making in a lot of years, right? So it indicates that the business model is a weak business model, right? So this is why CFO to EBITDA, CFO to PAT, and looking at cash flow walkthrough can help you a lot in your investing journey. Then we look at the defense companies, and even in defense companies, you'll see that the CFO to EBITDA for Hindustan Aeronautics is really good. For Bharat Dynamics is also really good. But for Astra Microwave, Zen Technologies and Data Patterns, the CFO to EBITDA is not that good, because majority of the money is stuck in your inventory, right? So majority of your money is stuck in inventory and trade receivables from the government. This is why these companies do not have very high CFO to EBITDA, right? So again, in these companies, if one is betting, then they have to be very careful, being aware that these companies have to keep piling more and more money into working capital. What is working capital? That is basically your trade receivables plus your inventory minus trade payables. So this is the problem with defense companies. Cable and wire sector. So on an average, all these companies, right, 5-year average, all these companies, KEI, Polycab, Finolex, right, Universal doesn't have that great CFO to EBITDA conversion. But on a 5-year average, these companies have high CFO to EBITDA conversion. 3-year average, KEI is bad, But in H1, that is first half of FY23, KEI's EBITDA to conversion, like CFO to EBITDA, has gone to 82%. Because earlier they had business to government business, which has actually been pruned down, and they are actually focusing more on business to consumer, which reflects in CFO to EBITDA ratio of FY23 first half. This is probably the reason why the stock also re-rated. Auto ancillaries, again, if you look at SGS, 72%, 78%. Right, Precall is actually on the higher end of things. So Precall first half of the financial year is close to 91%, right? Then if you look at some of the like not so good ones, that is RK Forgings at 62%, Steel Cast at 60 to 61%. But still, this is a sector where your CFO to EBITDA is much higher as compared to your like on an average as compared to your pharmaceuticals and defense sector, and and it is equivalent to your cable sector when it comes to CFO to EBITDA conversion. QSR companies, suppose if you go to eat a burger, will you pay money after 2-3 months? No. So you will pay money then and there at the time of purchasing the burger. If you just look at CFO to EBITDA over here, in this sector, your CFO to EBITDA on an average is above 70%, right? Because there is no credit given to you while you're having burgers. So look at the CFO to EBITDA for the steel tube sector. So for steel tube sector, the CFO to EBITDA for the market leader APL Apollo is close to 101% in first half of the financial year. 3-year average is 107%. For Surya Roshni, it is also really high at 95%, and 5-year average is 79%. For ISMT, which is going to be a Kirloskar company, it is at 66%, and first half of the financial year it is at 57%. But for JTL Industries, it is negative, and for high tech pipes, for first half of the financial year it is at 229%. But for the last two, like for 5-year average and 3-year average, it isn't that good, right? At 38% and 44%, right? So that is for the steel tube sector. Still, on an average, this sector has higher CFO to EBITDA conversion, because over here the market leader actually works on cash and carry model. You bring the money and you take the goods. That is one of the reasons why. For capital goods sector, CFO to EBITDA ratio for RHI Magnesita, it is at 56% on an average, because you have to maintain inventory for your steel customers, because if you do not have adequate inventory, then it could be a problem. So you'll see money getting stuck in inventory. For IFGL refractories, it is actually better than RHI Magnesita, but IFGL refractories, in my view, where it lags behind is because of lack of so much like diversity in products. And secondly, your other expenses are also, as a percentage of the expenses, is really high of P&L. Elecon Engineering also really good, because this has been a turnaround company at 130% for last 3 years. 5-year average is 102%. Jupiter Wagons has a really poor CFO to EBITDA conversion ratio, because it is dealing with the railways and business to government, right? SGEC has a 19% CFO to EBITDA conversion ratio. We can actually check SGEC as well. So this is a company which is basically into manufacturing of like capital goods for different industries like sugar, right? And if you just look at the operating profits, then EBITDA is like 345, 470 crore types, whereas your cash flow from operation has been really volatile, and in few years it has also been negative. So where is the money getting stuck in case of SGEC? So money is getting stuck in receivables, and money is getting stuck in inventory, right? So this is why the business hasn't been cash generating. For Usha Martin, again, like your CFO to EBITDA for last 3 years on an average, it has been good, like 77%. 5 years might not be the right metric, because simple reason is that this business used to have a steel business, like they used to have a steel mill themselves, which they sold off to one of the which they sold off to Tata actually. And if you just look at last 3 years, you'll see that post 2018, 2019, the company has turned into a profit making company. So this is the idea, that in turnaround companies, you have to go deeper into different time series and time frames to get an idea ki what is the CFO to EBITDA of this company. Hopefully this is helping you a lot as well, right? Because these are live case studies. Usha Martin is one of the companies which we have discussed on our channel a lot of times in last 2 years. Right, so over here, so this is with Usha Martin, with like Power Mech, it is at 119%, but for first half financial year FY23 it is at 37%. For Ratnami Metals, it is at 44% for last 3 years on an average, and 5 years on an average 50% types. Finally, coming to the consumer durables, or the contract manufacturing sector, as I would like to call it, that a contract manufacturing sector. And if we just look at the contract manufacturing sector, then you'll find that most of these companies, leaving apart from let's say like first half of the financial year wasn't good for them, but Sirma also has a 47% CFO to EBITDA conversion ratio for last 3 years, Amber has 93%, Dixon has 78%, PG Electroplast at 41%, and Keynes at 44%. So again, their money gets stuck in like working capital for some of these companies. And what ended up happening in Amber Enterprises, so this is an important case study, and why did Amber Enterprises stock fell as well? Because in first half of the financial year, this CFO to EBITDA turned negative, which points to pain in inventory and receivables management, right? You just look at this, the stock price has also fallen since then, and the valuations were also really high. But tracking the CFO to EBITDA along with valuations and along with the entire value chain can give you a lot of deep insights. They can actually give you a lot of deep insights, right? So this was the idea of CFO to EBITDA. And now coming to the book giveaway question. So book giveaway question is that in 2009 January, there was an accounting fraud in one of the listed IT companies in India. So question number 1 is A, what was the name of the company? And B, what was the fraud that company carried out in its books of account? So these are the two questions. So question number 1 is A, what is the name of the company? And question number 2 is, what did that company do which led to this fraud? And on grabs today is a book by the name of Quality of Earnings. And in the comment section below, we will be selecting 2 lucky winners who get this book. To participate in this quiz and book giveaway, make sure that you're subscribed to the channel. If you aren't subscribed, then make sure that you subscribe to the channel and also like this video. And now let's go towards the conclusion of the video. So in conclusion of this video, I would like to say that first point in this video that we learned is that why CFO to EBITDA is a very important ratio, and what is the meaning of cash flow from operations and what is the meaning of EBITDA. That cash flow from operations gives you a truer picture that how much cash the company is converting from operations, whereas EBITDA means cash operating profits, is that how much cash operating profits is the company earning from its accrual income statement. So this is the first thing that we learn. Second thing that we learn is that sometimes the companies have poorer CFO to EBITDA ratio simply because of 2 things. Either the money gets stuck in inventory, that the company is maintaining too much inventory, or the money gets stuck in trade receivables, that the company has to pay a lot, has to give a lot of credit to the companies, right? So this leads to a poor bargaining power, or it just shows that the terms of trade for the company are such. Third thing that we learned, that we need to combine CFO to EBITDA ratio with the borrowings of a company. If CFO to EBITDA ratio of a company is poor and the borrowings are really high, then it points to stress on the balance sheet. The company will either have to do an equity raising, or the company will have to raise more debt to basically run its operations. So this is the third thing that we learned. Fourth thing that we learned is that generally B2B businesses, like we saw throughout the session on the Excel sheet, generally B2B businesses will have a poorer CFO to EBITDA conversion ratio as compared to consumer oriented business. So this is one of the things that we learned. And also one thing that we need to focus on is that this thing or this homework of creating CFO to EBITDA ratio across all industries is something that you can do as well, because this will help you to identify companies which have better bargaining power with the customer versus those companies which have a poorer bargaining power with the customers. So these were the 5 key learnings from today's session. If you love this session, just drop a hell yes in the comment section below, and hopefully we'll keep making such videos for you in the future as well. Thank you so much for joining us. Hope to see you in the next video of SOIC. Jai Hind.